today because I want to get your take on what's going on here with Twitter, right? We saw a beat, some concerns about the guidance and the user miss. The stock's down over 10% this morning. I mean, what are the takeaways here?
Hey, good morning, Nicole. So, I think right now this earnings season is around digital advertising and social media. User growth has really been the biggest theme, a little bit more than usual, just given where we are in the cycle of, kind of COVID and lockdowns and the world reopening. Twitter put up a decent quarter. They were kind of in line. Their revenue guidance was just a slight miss, but their user growth is expected to decelerate into the high double digits. They've set a target for 20% growth over the next couple of years. They haven't changed that target, but as the world reopens back up, the growth there is going to slow a little bit, and that's what's got investors most concerned out of their print.
I just always felt like Twitter was something different. Facebook, the whole world got on it. Twitter originally felt like it was just for journalists and newsy folks. And, I think they always just had this hard time to have that user growth in the first place. So to hear about decelerating user growth going forward, it's tough. But at the same time, I'm seeing some moves from the stocks, and I still see some overweights. JP Morgan has an overweight and an $80 target. I know Wedbush, you brought your target down to $64. Deutsche Bank has a $67 target. It's a tough outlook to a certain extent, isn't it?
It is, and you're making all the right points. So that's kind of been the thing with Twitter over the years, is that it's been viewed as a little bit of a niche platform. And they've been putting in a lot of effort to expand that. Really, over the past couple of years, they're introducing a lot of new products to try to make it a little bit more usable for more people and have that drive stronger growth over the next couple of years. They put a lot of those things in place recently, and they had an investor day a couple months ago where they laid out this plan, and investors want to see them hitting on all those things. So that's part of the problem here right now is they just put out this grand vision, and now immediately, kind of a couple months after, we're talking about growth slowing, understandably to a certain extent, just because of what COVID was last year and everyone being locked down. But I think given its history and how it's viewed, we need to see really strong execution for the stock to keep moving from here.
Yeah, I see what you're talking about. I mean, you talked about Investor Day and how they really touted so much. Can we turn your attention to Facebook? I know that you're also looking closely at Facebook. So unlike Twitter, which we just said was a little bit of a niche platform, Snapchat, every teenager in America is on that. Facebook is definitely widely loved by grandma and the kids. It's sort of a broad base. In fact, they saw a big jump in sales, and it's been referred to the fact that it's in a sweet spot. Do you think it's in a sweet spot?
I think at least parts of it are in a pretty big way. And look, the big guys, Facebook and Google, really outperformed this quarter. Their growth was way ahead of expectations. Their outlooks were ahead of expectations. And these big digital advertising behemoths seem to only be getting stronger in this market. So that's really positive for Facebook. Facebook has some engagement challenges also coming forward. They talked about it a little bit as well, but like you said, Facebook's already so big. And they've got some really interesting products around commerce and areas where they're focused on bringing commerce onto the platform. And I think Instagram continues to get stronger in a world where social commerce gets bigger. So they are, I think, in a sweet spot in a lot of ways, to your point.
Tell me about the price target raise. I see 331.81 was the high just, now recently this week. And you have raised your target, right, to 355, but a neutral rating. So you're not saying rush out and buy it, but you think it can trend higher? I mean, what does this mean exactly?
Yeah, so look, I think we have to give them credit for the results that we saw in the first quarter, for the guidance and outlook for the second quarter, and the fact that they're growing their business so much. The digital ad environment is very strong. We're seeing advertising as a whole rebound, and they are positioned pretty well there. there are a few things that do concern us a little bit. One of those things is engagement. Pinterest got really hit on their engagement outlook. Twitter got hit pretty hard. Facebook's engagement outlook wasn't fantastic, but they got a little bit of a pass just because of how much bigger they are, and how well they did in their results in the first and second quarter. We also think Facebook's the most exposed to the changes that Apple's putting in on iOS 14.5, where the privacy standards are tighter, and it's going to become harder to track users and target them. Facebook's been by far the best at that. That's been their biggest strength, and so we think a more level playing field can hurt Facebook the most relatively. So as that rolls out, we're a little bit cautious on that area as well.
I see. Okay, that's a good point. I'm glad you brought that up, because there was a lot of talk whether or not that would be a good thing or a bad thing. They were trying to spin it, right? Everybody's trying to spin it to something positive. eBay, Shopify, these are names that you cover. In fact, for eBay, you recently downgraded the stock to a neutral. What's missing from eBay as the behemoth of Amazon is just soaring after a record quarter for revenue? What's eBay missing?
Well, so for e-commerce, we're in a pretty critical area right now. E-commerce as a whole over the past year really took a lot of share of total retail. It was a tide that lifted all boats. And now as we lap all those gains over the last year, we're investors and trying to understand who's capturing those gains the most, and who might be giving them back. So, what we saw from Shopify is that they continue to expect growth year over year off of the COVID comps. Amazon's expecting the same thing. eBay in their outlook talked about giving some of those gains back, so they're expecting a year-over-year decline in their GMV and their sales. So I think that was one area that concerned us a little bit. We want to see the winners that are able to hold on to the gains that they saw out of this new consumer shopping behavior environment. And I think there's a little bit of a question mark, at least around eBay, given their outlook.
Yeah, well, I'm out of time, but just quickly, the consumer, is it more about the consumer not going to spend as much, done with my stimulus checks, I got everything I needed online, or is it more about consumers returning foot traffic back to brick and mortar?
In my view, it's less about brick and mortar, and it's more about where people are going to spend outside of commerce. So I think as the world reopens, the biggest shift is going to be the travel and entertainment and non-shopping things. But I think structurally, e-commerce has captured those gains, and we'll hold on to them.